Question 1, scenario-based. Mr. Taylor is 68 years old and recently suffered a minor stroke. His medical condition has stabilized, but he has difficulty performing 2 of the 6 activities of daily living adults: dressing and bathing. He's considering filing a claim on his long-term care insurance policy, which has a 90-day elimination period. What must Mr. Taylor do to qualify for benefits, and when can he expect the payments to begin if approved? A. He must demonstrate that he cannot perform at least 3 ADLS, and payments will begin immediately after the claim is approved. B. He must demonstrate that he cannot perform 2A DLS or has cognitive impairment, and payments will begin after the 90-day elimination period if proved. C. He must prove cognitive impairment and that he cannot perform all 6 adults, and payments will begin 30 days after the claim is approved. D. He must meet the DL requirement and wait 60 days after the claim approval to start receiving benefits. Answer. B. Explanation. To qualify for LTC benefits, Mr. Taylor must meet the policy's benefit triggers, which typically require being unable to perform at least 2 DLS or having cognitive impairment. Since Mr. Taylor cannot perform 2 EBLs, he meets this requirement. His policy has a 90-day elimination period, meaning he must wait 90 days from the time of his claim approval before benefits begin. According to HIPAA 8 guidelines, most tax-qualified LTCI policies follow the 2 EDL standard for triggering benefits. Question 2. Which of the following is a common exclusion in most long-term care insurance LTCI policies? A. Coverage for Alzheimer's disease if diagnosed after the policy is purchased. B. Coverage for care provided by immediate family members without compensation. C. Coverage for services received in a licensed assisted living facility. D. Coverage for home health care services provided by a registered nurse. Answer. B. Explanation. Most LTCI policies exclude coverage for care provided by immediate family members unless they are licensed professionals and are compensated. This is to prevent abuse or fraudulent claims. Coverage for Alzheimer's disease is generally included, provided the diagnosis is made after the policy is purchased. Licensed assisted living facilities and home health care services provided by registered nurses are typically covered under LTCI policies. Alaska-specific consumer protection laws also reinforce these standards. Question 3. Which factor is likely to increase the cost of an individual's long-term care insurance premium the most? A. Selecting a policy with a 180-day elimination period. B. Opting for simple inflation protection instead of compound. C. Choosing a longer benefit period, such as lifetime coverage. D. Choosing a maximum daily benefit that is below the average cost of care in Alaska. Answer. C. Explanation. A longer benefit period, such as lifetime coverage, significantly increases the cost of LTCI premiums because the insurer assumes a greater risk. Lifetime benefits mean the policy will continue paying for care for an unlimited amount of time, as opposed to a shorter benefit period like 3 or 5 years. Inflation protection also impacts premiums, but compound inflation protection is more costly than simple inflation protection. A longer elimination period, such as 180 days, tends to lower premiums. The maximum daily benefit must at least cover the average cost of care in Alaska to ensure adequate coverage. Question 4. Which of the following is true regarding the tax treatment of long-term care insurance premiums under federal law? A. Premiums for non-tax qualified policies can be deducted as medical expenses if they exceed a certain percentage of income. B. Tax-qualified long-term care insurance premiums are fully deductible regardless of income level. C. Tax-qualified long-term care insurance premiums can be deducted as medical expenses, subject to age-based limits and income thresholds. D. All long-term care insurance premiums are exempt from federal taxes if the policyholder is over 65. Answer. C. Explanation. Under federal law, tax-qualified long-term care insurance premiums are treated as medical expenses and can be deductible if they exceed a certain percentage of adjusted gross income. The amount deductible is subject to age-based limits as defined by the IRS. Non-tax qualified policies are not eligible for this deduction. For 2023, medical expenses, including qualified LTCI premiums, are deductible if they exceed 7.5% of a taxpayer's AGI. Question 5. Which of the following correctly describes the coordination of long-term care insurance benefits with Medicare? A. Medicare covers long-term custodial care in a nursing home for as long as medically necessary. B. Medicare primarily covers skilled nursing care and rehabilitative services, but only for a limited period following hospitalization. C. Medicare and long-term care insurance always provide the same type of benefits for the same services. D. Medicare will fully pay for all home health care services if you have a long-term care insurance policy? Answer: B. Explanation. Medicare provides limited coverage for long-term care. It primarily covers skilled nursing care and rehabilitative services following a hospital stay of at least 3 days, but only for up to 100 days, with full coverage for the first 20 days and coinsurance required after that. Custodial care, which includes assistance with adults, is not covered by Medicare. Long-term care insurance policies fill this gap by covering custodial care and services not typically covered by Medicare. Question 6. Under Alaska law, which of the following is a requirement for a long-term care insurance policy to be approved by the Alaska Division of Insurance? A. The policy must offer lifetime benefits. B. The policy must provide at least a 60-day elimination period. C. The policy must offer inflation protection and include non-forfeiture benefits as mandatory options. D. The policy must exclude coverage for Alzheimer's disease and related cognitive impairments. Answer: C. Explanation. Under Alaska law, long-term care insurance policies must offer inflation protection as an optional feature, allowing the policyholder to choose between simple and compound inflation adjustments. Non-forfeiture benefits, which allow the policyholder to retain some value in the policy if it lapses, must also be offered as an option. Excluding coverage for Alzheimer's disease and cognitive impairments is not permitted, as these are common conditions triggering the need for long-term care. Question 7. Scenario-based. MS. Carlson, age 72, purchased a long-term care insurance policy 5 years ago with a maximum daily benefit of $200 and compound inflation protection. Due to inflation, the cost of care in her area has increased significantly and her current benefit has grown to $260 per day. If MS. Carlson enters a nursing home where the cost of care is $280 per day, what will her insurance cover and what will be her out-of-pocket expense? A. The insurance will cover $200 per day and MS. Carlson will pay $80 out of pocket. B. The insurance will cover $260 per day and MS. Carlson will pay $20 out of pocket. C. The insurance will cover $280 per day and MS. Carlson will have no out-of-pocket costs. D. The insurance will cover $240 per day and MS. Carlson will pay $40 out of pocket. Answer: B. Explanation. MS. Carlson's policy has compound inflation protection, which increases the daily benefit each year to keep pace with rising care costs. After 5 years, her benefit has grown from $200 to $260 per day. Since her nursing home costs $280 per day, the insurance will cover $260, and she will need to pay the remaining $20 out of pocket. Compound inflation protection is crucial in LTC policies, especially in areas where the cost of care rises faster than average inflation rates. Question 8. Which of the following describes a common reason for the denial of a long-term care insurance claim? A. The policyholder requires help with only one ADL, but the policy requires inability to perform at least 2 ADLs for benefit eligibility. B. The policyholder has cognitive impairment but is able to perform all adults. C. The policyholder is receiving care from a family member who is a licensed nurse. D. The policyholder filed a claim during the policy's elimination period. Answer: A. Explanation. Most LTCI policies have specific benefit triggers, often requiring that the policyholder be unable to perform at least 2 of the 6 ADLs, e.g. eating, bathing, dressing, to qualify for benefits. If the policyholder can still perform all but 1 ADL, the claim is likely to be denied. Cognitive impairment can also be a benefit trigger if it is explicitly included in the policy, and receiving care from a licensed family member may be covered depending on the policy. Claims filed during the elimination period are also typically denied until the waiting period is completed. Question 9. What is the purpose of the Alaska Long-Term Care Partnership Program? A. To provide tax deductions for long-term care insurance premiums for all Alaska residents. B. To allow long-term care insurance policyholders to protect a portion of their assets from Medicaid spend-down requirements. C. To provide free long-term care coverage to low-income residents who do not qualify for Medicaid. D. To mandate that all long-term care insurance policies in Alaska offer a minimum of 5 years of coverage. Answer: B. Explanation. The Alaska Long-Term Care Partnership Program allows policyholders who purchase qualifying long-term care insurance to protect some of their assets if they later need to apply for Medicaid. The program encourages residents to purchase private long-term care insurance by allowing them to protect a dollar amount equal to the amount of benefits paid out by their policy. This asset protection helps individuals avoid exhausting their entire savings before becoming eligible for Medicaid assistance. Question 10. What is a key consideration when choosing between simple and compound inflation protection in a long-term care insurance policy? A. Simple inflation protection increases benefits at a fixed dollar amount each year, while compound inflation protection increases benefits at a percentage of the previous year's benefit. B. Compound inflation protection increases benefits only every 5 years, while simple inflation protection increases benefits annually. C. Simple inflation protection is required in all policies sold in Alaska, while compound inflation protection is optional. D. Compound inflation protection is less expensive than simple inflation protection but offers lower long-term benefit growth. Answer A. Explanation. Simple inflation protection increases the policy's benefits by a fixed dollar amount each year, while compound inflation protection increases benefits by a percentage, typically compounding each year. Compound inflation protection is more expensive but results in greater benefit growth over time, especially in periods of high inflation. Alaska law requires that both simple and compound inflation protection options be offered, but neither is mandatory to purchase. Question 11. Which of the following describes how the elimination period in a long-term care insurance policy works? A. The elimination period is the period of time during which the policyholder must pay premiums before benefits begin. B. The elimination period is the number of days the policyholder must wait after becoming eligible for benefits before the insurance begins to pay it. C. The elimination period is the period during which the policyholder must continue to receive care before the policy can be renewed. D. The elimination period is the time the policyholder has to decide whether to accept or reject a policy after purchasing it. Answer B. Explanation. The elimination period in a long-term care insurance policy is similar to a deductible, but instead of money it refers to a waiting period. It's the number of days the policyholder must wait after becoming eligible for benefits, such as when they can no longer perform at least 2 adults before the insurance starts paying for services. This period is typically 30, 60, or 90 days, depending on the policy. Question 12. What is the primary benefit of having a non-forfeiture clause in a long-term care insurance policy? A. It guarantees the policyholder a refund of all premiums paid if the policy is cancelled. B. It ensures that the policyholder will still receive some benefits even if the policy lapses due to non-payment of premiums. C. It locks in the premium rates for the life of the policy even if the insurance company increases premiums for other policyholders. D. It allows the policyholder to switch to another insurance company without losing coverage. Answer B. Explanation. A non-forfeiture clause ensures that if a policyholder's long-term care insurance policy lapses due to non-payment of premiums, they are still entitled to some portion of the benefits or a reduced benefit amount based on the premiums paid. This feature provides some protection for the policyholder if they can no longer afford the premiums but want to retain some coverage. Question 13. In Alaska, which of the following is true regarding long-term care insurance policies with respect to Alzheimer's disease? A. Long-term care insurance policies in Alaska may exclude coverage for Alzheimer's disease. B. Long-term care insurance policies in Alaska must cover Alzheimer's disease as it is classified as a severe cognitive impairment. C. Alzheimer's disease is covered only under specific conditions in Alaska long-term care policies. D. Alzheimer's disease is covered under Medicare, but not under private long-term care insurance in Alaska. Answer B. Explanation. Alzheimer's disease is classified as a severe cognitive impairment, and under Alaska law, long-term care insurance policies are required to cover care for policyholders who develop Alzheimer's or similar cognitive impairments. Excluding coverage for Alzheimer's disease would not be permissible. Question 14. Which of the following accurately describes the role of an insurance producer in selling long-term care insurance in Alaska? A. Producers must be specially licensed to sell long-term care insurance in Alaska. B. Producers in Alaska are not required to undergo any special training to sell long-term care insurance. C. Producers are required to undergo continuing education specifically related to long-term care insurance. D. Producers may only sell long-term care insurance through government-approved agencies. Answer C. Explanation. In Alaska, insurance producers who sell long-term care insurance must complete specific continuing education requirements related to long-term care insurance. This ensures that they stay informed about policy options, regulations, and best practices to properly advise clients on long-term care insurance products. Question 15. Which of the following individuals would most likely be eligible for Medicaid assistance for long-term care in Alaska. A 72-year-old individual with substantial assets but minimal income who needs custodial care. B. A 65-year-old individual with limited assets and income who requires skilled nursing care after a hospitalization. C. A 55-year-old individual with moderate income who is receiving home health care. D. A 60-year-old individual with substantial income but no assets who requires assisted living. Answer: B. Explanation. Medicaid provides assistance to individuals who meet certain income and asset thresholds. In Alaska, individuals with limited assets and income who require skilled nursing care, often after a hospitalization, would likely qualify for Medicaid assistance. Medicaid primarily assists those with financial need and covers both skilled and custodial care depending on the individual's medical condition. Question 16. Which of the following is a common feature of a partnership long-term care insurance policy in Alaska? A. It provides lifetime benefits without an elimination period. B. It allows the policyholder to protect a portion of their assets if they later apply for Medicaid. C. It includes guaranteed premium stability, preventing rate increases. D. It mandates coverage for home health care services only. Answer: B. Explanation. A partnership long-term care insurance policy in Alaska allows policyholders to protect a portion of their assets if they need to apply for Medicaid after exhausting their long-term care insurance benefits. This protected amount is not counted toward the Medicaid asset limit, which is a key feature of partnership policies. Question 17. In Alaska, what is the minimum number of days for a policyholder to return a long-term care insurance policy for a full refund under the free look period? A. 10 days. B. 20 days. C. 30 days. D. 45 days. Answer: C. Explanation. In Alaska, long-term care insurance policies must include a 30-day free look period. This means policyholders have 30 days from the date they receive the policy to review it, and if they are not satisfied, they can return the policy for a full refund of premiums paid. Question 18. Which of the following is an important consideration when deciding the length of a long-term care insurance policy's benefit period? A. The length of the benefit period determines how soon the premiums increase. B. A shorter benefit period results in higher premiums but provides more coverage. C. A longer benefit period reduces the likelihood that the policyholder will need Medicaid. D. The length of the benefit period is unrelated to the overall cost of the policy. Answer: C. Explanation. Choosing a longer benefit period increases the likelihood that a policyholder will have enough coverage to avoid depleting their assets and needing Medicaid assistance. Longer benefit periods are generally more expensive but provide more protection in case long-term care is needed for an extended time. Shorter benefit periods may reduce premiums but increase the risk of needing additional financial resources later. Question 19. Which of the following types of care is most commonly covered by long-term care insurance? A. Acute hospital care. B. Home health care. C. Routine doctor visits. D. Cosmetic surgery. Answer: B. Explanation. Long-term care insurance commonly covers home health care services, which include assistance with activities of daily living, adults such as bathing, dressing, and mobility. The goal of long-term care insurance is to provide for extended care needs that are not typically covered by health insurance or Medicare, such as custodial care in the home or in a facility. Question 20. How does a shared care rider in a long-term care insurance policy benefit a couple? A. It allows both individuals to share a common elimination period. B. It enables both individuals to share their total pool of long-term care benefits. C. It provides each individual with lifetime coverage regardless of the other's usage. D. It allows one individual to use the other's policy if one is cancelled. Answer: B. Explanation. A shared care rider allows a couple to share their combined pool of long-term care insurance benefits. If one individual exhausts their benefits, they can access the other's remaining benefits. This feature is beneficial for couples because it offers flexibility and ensures that both can receive adequate coverage if one partner requires extensive care. Question 21. What is a primary advantage of selecting an inflation protection option in a long-term care insurance policy? A. It guarantees that the premium will remain level throughout the policy term. B. It increases the policy's benefit amount to keep pace with rising healthcare costs. C. It allows policyholders to cash out their policy after a set number of years. D. It eliminates the need for an elimination period. Answer: B. Explanation. Inflation protection ensures that the benefits in a long-term care insurance policy will increase over time to keep up with rising healthcare costs. Without this option, the policy's fixed benefit amount could become inadequate to cover the cost of long-term care in the future due to inflation. Question 22. In Alaska, which of the following would likely be considered an activity of daily living adult in a long-term care insurance policy? A. Managing finances. B. Feeding oneself. C. Taking medication. D. Reading. Answer: B. Explanation. Feeding oneself is a commonly recognized activity of daily living adult in long-term care insurance policies. DLS are essential tasks that an individual must be able to perform to maintain independence, and most long-term care policies provide benefits when assistance is needed with multiple DLS such as bathing, dressing, and mobility. Question 23. Which of the following is true regarding the tax treatment of long-term care insurance premiums in Alaska? A. Premiums paid for long-term care insurance are fully tax-deductible for all policyholders. B. Premiums are not deductible under any circumstances. C. Premiums may be deductible as a medical expense if they exceed a certain percentage of adjusted gross income. D. Only policyholders over the age of 65 can deduct premiums from their taxable income. Answer: C. Explanation. In Alaska, as in many other states, long-term care insurance premiums may be deductible as a medical expense on federal income tax returns if they, along with other medical expenses, exceed a certain percentage of the taxpayer's adjusted gross income. The IRS sets limits based on age, and the deduction is subject to specific conditions. Question 24. Which of the following is not typically covered under a long-term care insurance policy in Alaska? A. Custodial care in a nursing home. B. Home health care services. C. Skilled nursing care after hospitalization. D. Elective cosmetic surgery. Answer: D. Explanation. Elective cosmetic surgery is not typically covered under long-term care insurance policies. These policies are designed to cover services related to personal care and assistance with activities of daily living, such as custodial care, home health care, and skilled nursing care, rather than elective or cosmetic procedures. Question 25. Which of the following scenarios would most likely trigger benefits from a long-term care insurance policy in Alaska? An individual requires physical therapy for a sports injury. B. An individual is unable to perform two activities of daily living adults without assistance. C. An individual is recovering from a cold and needs temporary and home nursing care. D. An individual needs transportation to routine medical checkups. Answer: B. Explanation. A long-term care insurance policy typically pays benefits when the policyholder is unable to perform at least two activities of daily living adults, such as bathing, dressing, or eating, without assistance. This is a common trigger for benefit eligibility in long-term care policies. Question 26. Which of the following best describes the guaranteed renewable feature of a long-term care insurance policy? A. The policyholder can renew the policy every year, subject to approval by the insurance company. B. The insurance company cannot cancel the policy as long as the premiums are paid, but it may increase the premiums. C. The policyholder can renew the policy without paying any additional premiums after a certain age. D. The insurance company is required to automatically renew the policy at the same premium rate. Answer: B. Explanation. A guaranteed renewable long-term care insurance policy means that the insurance company cannot cancel the policy as long as the policyholder continues to pay the premiums. However, the insurance company does have the right to increase the premiums, provided the increase applies to all policyholders in the same class. Question 27. In Alaska, what is the typical role of a long-term care ombudsman? A. To help residents of long-term care facilities resolve complaints or issues regarding their care. B. To provide legal representation for individuals seeking long-term care insurance benefits. C. To sell long-term care insurance policies to individuals and families. D. To audit long-term care insurance companies for regulatory compliance. Answer: A. Explanation. A long-term care ombudsman in Alaska works as an advocate for residents of long-term care facilities. They assist in resolving complaints, ensuring that residents receive proper care and treatment, and addressing any concerns that residents or their families may have about their care. Question 28. What is the primary purpose of an underwriting process in long-term care insurance? A. To evaluate the financial stability of the insurance company. B. To determine the premium rates based on the policyholder's health and risk factors. C. To ensure the policyholder receives a full refund if they cancel the policy within the free look period. D. To verify the insurance company's compliance with state regulations. Answer: B. Explanation. The underwriting process in long-term care insurance is used to assess the health and risk factors of the applicant. Based on this evaluation, the insurer determines the premium rate and whether to offer the policy. Individuals with pre-existing conditions or higher health risks may face higher premiums or denial of coverage. Question 29. What is the significance of a waiver of premium provision in a long-term care insurance policy? A. It eliminates the need to pay premiums if the policyholder becomes unemployed. B. It suspends premium payments once the policyholder begins receiving benefits. C. It allows the policyholder to receive a refund of premiums paid during the first year of coverage. D. It ensures that premiums are reduced after the policyholder reaches a certain age. Answer: B. Explanation. A waiver of premium provision allows the policyholder to stop paying premiums once they begin receiving benefits from their long-term care insurance policy. This provision is common in many policies and helps to alleviate the financial burden during a period when the policyholder is already incurring expenses for long-term care. Question 30. Which of the following would be considered a qualified long-term care insurance policy under federal tax rules? A. A policy that covers only elective medical procedures. B. A policy that provides benefits when the policyholder cannot perform at least 2A DLS for a period of at least 90 days. C. A policy that requires a 60-day elimination period before any benefits are paid. D. A policy that covers medical expenses unrelated to long-term care needs. Answer: B. Explanation. Under federal tax rules, a qualified long-term care insurance policy must provide benefits when the policyholder cannot perform at least 2 activities of daily living able for a period of at least 90 days or has a cognitive impairment. The policy must also meet other specific requirements, such as having inflation protection for certain age groups.